Hey, everybody. Welcome to our quarterly macro presentation. Excited to have you guys with us today. My name's Andrew Hall. I'm the president of Narwhal Capital Management, joined today by Benjamin Nye, Chief Investment Officer. Ben, how we doing?
Hanging in there.
Yeah.
It's day to be active.
Yeah. Yeah. So we figured we'd take a break and just talk for a while. And Tom Russell, Director of Fixed Income. Tom, what's up?
I feel great. Bonds are as expensive as they've been in probably more than 3 years, two
Yeah.
years. It's a good time to be a bond owner.
Yeah. Yeah.
It
Yeah.
has not been since 2021, but it
Um,
is now.
Tom is quite excited. Everybody else, maybe not so much, but nonetheless, we are here. We appreciate you for joining. As always, we're going to try to get this uploaded as a YouTube video. So if you're watching now, but you can't see the screen for whatever reason, or you want to look at the notes, we'll have that link up and probably publish the presentation as well on the blog early next week. So be on the lookout for that. If you have questions, I would encourage you to put them in the chat. Please, no useless fodder in the chat. We're going to try to keep up with the questions. Some of them we may take as we go. Some of them we may answer at the end. And if they're dumb, we won't answer them at all. There are such things as stupid questions when we do our macro presentation. Any other time, no such thing. But during this, they're dumb ones. We're going to try to get you in and out in under an hour. So with that, I'll turn it over to Ben and we'll get rolling.
Yeah, we want to really address. We initially a couple weeks ago when we were putting this together, we had only done our macroeconomic outlook for the full year just about a couple months ago or a month and a half ago. So we were a little bit, wary of getting people out to the office and things like that. So we decided to do it on Zoom, and I think that it's been useful to do that too because we have a lot of clients who might not live in Atlanta, and we wanted to make sure that this you guys hear this as well. And so, to Andrew's point, please certainly give us any questions that you have in the chat because we really want to allow this to be a forum for you as well as we're going through a lot of these subjects. So the subjects after the disclosure. So take a picture of that. So you know that.
Notably, the second paragraph, we are not under duress.
Yes. Well, depends on who you ask.
Being paid to be here.
But what we're going to be talking about is this rocky market that we've had. It's, it does feel like we're in the 10th round of a boxing match right now, and it doesn't feel pleasant. Noses are bloody. And, we own stocks, you own stocks, and it has not been a good period for stocks. Last year was, this year has not been. And so really want to address that, what's going on, establish where we think things are and where things are potentially going. And the thing that we really want to start off with is going to be tariffs. We're going to be touching on 5 different themes today. The first one is going to be tariffs. The second one is going to be just the market forces. The third one is going to be an update on where inflation is and where it could be going. Fourth is going to be interest rates. And the last is going to be where the economic activity is. And what we want to be discreet and discerning about is the difference between where the data is and where the narratives are. Over the course of this presentation, those are 2 things that we want to really differentiate between, because what the narrative is telling us is something that is potentially entirely different than what the data is telling us right now. The data could change, but the narrative is very, very different. And so starting off with the narrative of the tariffs, this is the timeline that we've had since the Trump inauguration on January 20th of this year. And there have been tariffs that have come on. There have been tariffs that have come off. There have been tariffs that have been threatened to come on, and the tariffs that have come off as well. And so right now, we have about as much certainty as we've ever had. That doesn't mean that we have certainty on tariffs, Andrew. And, as we go forward, this is the best summary on the next slide, Jonathan, is the best summary of really where we are today. And that's 20% on China. We have 25% on non-compliant Canada, Mexico goods, 25% steel, aluminum, 25% automotive, again, for non-compliant, and then reciprocal tariffs. And the reciprocal tariffs were just announced earlier this week, and that has really caused the big decline in the stock market over the last couple of days.
Yeah, and I think if you look thematically at what we've seen priced in specifically as it relates to tariffs over the past 2 months or so, you first had a real wave of uncertainty. We talked about this even at our economic symposium event back in February. And we told you then, and we cautioned you yet again now, that no one really can concretely tell you what the ultimate impact of these tariffs is going to be. There will be change. Obviously, we had Liberation Day earlier this week. It liberated a lot of portfolios from their unrealized gains. And other than that, there's been a lot of really aggressive and sharp reaction, and in some cases, potentially overreaction to that. Right now, this is where we stand. The market did not like the uncertainty, and they certainly did not like these very elevated levels on these tariffs that we've seen. I would argue, though I don't know, that this is probably the ceiling that we were going to see. But for now, where we stand is in a place in which the market is still aggressively trying to digest numbers that were much larger than the market expected. Although I would argue that internally, I don't know that we were necessarily shocked by the tone of this.
Yeah, I think a good way to put it, Howard Marks was on Bloomberg earlier today, and he basically said, this is an economic snow globe. Basically, Trump picked up the global trade snow globe and gave it a shake. And for the moment, we are at uncertainty as how all this will play out. But in a year from now, the policies will be set, everything will be in motion, and there will be a lot of understanding of where we'll be. And there will be winners and there will be losers. There are probably going to be some countries that are punished perhaps unfairly, either for their size or what they provide for the U.S. But uh, a drastic change needed to be made, and in a lot of ways, the easiest way to do it is rather than just, hey, we're going to slowly move, we're going to do this, we're going to do that. The trick is to shake the snow globe, and then eventually you'll see where the dust settles.
And I think the big what is our view of the context of this? Our view of the context is we came into this year, and I've talked about the masking effect quite a bit. I talked about it in February. I talked about that there was going to be chop as we hand off from the public sector to the private sector. The way that you get rid of a $1.5 trillion deficit is to increase revenue and decrease spending. And you can increase revenue in many different ways. You can decrease spending in many different ways. The way that they've chosen to decrease spending is through the Department of Government Efficiency, and we'll talk about that toward the end. The way that they've chosen to increase revenue is not higher income taxes, but in part these tariffs. Primarily, they have some other kind of gimmicky things like the Trump Gold Card, but overall, there's pain in deficit reduction. If you think about what the deficit is, it's government spending that hasn't been paid for. So if we have a $29 trillion economy and $1.7 trillion of that is government net spending that hasn't been accounted for, then when you pull that back, either through tariffs or through cost cutting or through higher taxes, there's going to be a pain to the tune of $1.7 trillion. And so, can we pass the baton from the public sector to the private sector? That's going to be the reason for the chop that we've had in the first half of the year. And that's going to be the question for the second half. But what does it mean in terms of a tariff perspective? Because we've seen all these numbers, but I really want to put in context here what it actually means from what the prices are going to be charged for you when you buy a product. So bear in mind, about 70% of the GDP is consumption, personal consumption, and about 70% of that is services spending. 30% is goods. So we're talking about 30% of 30%. 30% of 70%, excuse me, 21% of the economy. So first of all, that's where we're starting. When we're talking about tariffs on personal goods, we're talking about tariffs on 21% of the economy, not 100% of the economy. I think that's important to differentiate. And then when we're looking at tariffs, this is a case study of how they could potentially be passed through. So we've heard a lot about people passing through a 25% increase. Your running shoes, instead of going to be $100, they're going to be $125. Your vehicles, instead of being $50,000, are going to be $62,500. But I want to illustrate what it actually means when you pass through the costs. So we did analysis of General Motors. In 2024, their total revenue in the United States was $157 billion dollars. For those products, it cost them $135 billion dollars to make it. They made a profit of $22 billion dollars. Not all of that cost of goods was materials. Only two-thirds of it was materials, $90 billion dollars. They only imported less than half of their vehicles. So you're talking about, $41 billion dollars of actual material inputs. Well, a 25% tariff on that amounts to $10 billion dollars, which on a base of $157 billion dollars of revenue means that even if you pass through the entire tariff, you're talking about a 6.5% increase on prices. For context, immediately after COVID, new car prices were up about 11% is where they peaked. So if we go to the next slide, we actually came up with what does this mean in terms of actual price increases. So the average price of a vehicle in the United States is $48,000. We decided to use $60,000 because it would the numbers just worked a little bit better. The price per month on that loan at current interest rates today, and I know there are interest rate buy downs, would be $1,037 per month for 72 months. That's how much it would cost you to buy a $60,000 vehicle. If we pass through in the entire amount of the tariff costs, that payment goes up $70 to $1,100 per month. That's inflation. I think that it's a little bit less jarring than hearing that your car just became $15,000 more expensive. Importantly, that number 3 comment is Trump has talked about reinstituting the deductibility of auto loan interest. And if you did that, your payment would actually be slightly down on net versus where it was before. So these are very important things to keep in context. We have airfares right now that are crashing worldwide. I mean, you can get to and from London for $600 in September if you really want to, or in May if you want to make a last minute travel plan. So I think there are a lot of reasons to be less fearful and dramatic about this than perhaps the markets are saying.
Yeah, I think an underrated piece too is when it comes to auto ownership, total cost of ownership is a big piece. And, lost in the shuffle yesterday was that oil prices were down 8% and that gas prices at the pump have been falling precipitously over the last few months. So you could even argue that just the change in the price of gasoline as a result of the, panic or overselling we've seen in the last couple of days would offset any cost attributed to the total ownership of that car. And also, we've talked ad nauseum on our morning calls that auto insurance has been one of the leading drivers of inflation over the last couple of years because it is following on the increase in prices we saw during COVID. And that's probably getting to the point where it's topped out. We're probably not going to see double-digit inflation on auto insurance. We may actually see some of that come back. And so when you filter it all through, the real net effect is relatively negligible, particularly as it relates to just, if you're thinking, I'm going to buy a car, I'm going to put gas in that car, I'm going to drive that car around, and I'm going to put a note on it. Also notably, interest rates have absolutely cratered in the last 48 hours. The 2-year Treasury at one point today was looking to break through 3.5%, which is a far cry from the 5.5% we saw just 2 years ago. It's come back a little bit. Jay Powell has been talking a bit hawkishly. He's still talking now, but we've seen a little bit of a retracement there. But I mean, that is a massive fall from just where we were within the last 18 months.
When you think about it, and Andrew brought this up yesterday on our morning call, the aggregate amount of tariffs that has been targeted by Peter Navarro has been $700 billion in revenue. That's about on $4 trillion of imports. I think that's a high watermark, but that's 2.5% of the U.S. economy. So I think that type of context is important to really take note of. And I think that there are some pockets that can be really hurt by this. And I don't want to discount that. And there could be a case of I don't have to raise prices, but I can. I can use tariffs as an excuse. So you do have those factors, and I don't want to discount those factors. But in terms of the actual monetary impact for some of these companies, I think it is somewhat manageable.
And I think globally, as you think about this, you cannot be worried that tariffs are going to cause, call it, an additional 2.5 percentage points on inflation, and worried that tariffs are going to hurt GDP by 2.5%. Those two things can't be true. If something is actually being realized as a price increase due to a tariff, it's because someone is still purchasing it. There will be some decisions that people will have to make in which they say, you know what, maybe because of this tariff or because of a corporate stance that's taken related to a tariff, I just can't afford that.
And it's
That
also
that won't be an inflation input for your household. It will be a reduction in spending.
it's also worth noting that, I am very much in the camp that the M2 money supply is what drives inflation. What we did was we increased the number of dollars in circulation by roughly 4x. Uh, you have X number of dollars, you increase that number of dollars, each dollar is worth less. The M2 money supply over the last 2 years has been negative. It's slightly positive now, which is more in line with where it's been historically. But that's really what drives inflation. You had tons of money being printed. That money was distributed to people who turned around and they bought stuff. And they bought a lot of stuff at the same time. We had supply chain issues. And that drove inflation like crazy, like just absolutely insane. You had super high demand. Each dollar is worth less. There's lots of stuff, and it was in limited supply. And that's where inflation comes from. If any company just goes around and says, "Hey, I'm going to change the price of my Nikes from $80 to $90," that not is not necessarily inflation because you don't know that people are going to buy it at that price, and then supply and demand will dictate whether that price stays there or comes back down. I mean, we're seeing that with food. I mean, we're seeing egg prices come down. We're seeing a lot of companies having to roll back their price increases because demand is not there. I mean, be it Nike or Pepsi or any number of retail spots, you're seeing that they pushed a lot of price through. It's gotten too expensive. Demand is dropping. Therefore, price is also dropping.
On a go forward basis, my last point on tariffs is where do we go from here? There is a potential that you'll see countries retaliate like China's doing. Today, they announced a new 34% tariff on imports of U.S. products, which could potentially hit companies like Apple or Nike or Starbucks has really bet on China. But I also think that the way that the tariffs have been calculated present a number of negotiating opportunities for a lot of countries. For example, the tariff calculation is based on a difference between the exports and imports. If I'm Germany, I'm going to go to the United States and say, "Look, we'll buy we'll buy U.S. oil and natural gas. You're increasing your imports on something you'd have to buy anyway. Maybe you pay a couple dollars extra, but you do that, and then naturally your tariff rate comes down by virtue of the formula that was created." Now, a lot has been made about the formula and how it was kind of contrived. It doesn't really matter because it provides a negotiating opportunity. And I think that tariffs are really viewed as both. I think there's not an either or right now. I think they're used as both a revenue source and a negotiating opportunity. Moving on to markets. So markets have obviously sold off. They were selling off in the first quarter as well. Foreign ownership, I think, has dictated a decent amount of this sell-off. Not the most recent sell-off of obviously this week, but certainly in Q1. And the reason is this report gets published every year. It gets published about 8 months late. So this data is from the end of June 2024. It was published in early March. And what it does is it shows you that 17 trillion of the 57 trillion dollars in the US stock market was owned by foreign investors. 2 trillion of that was foreign official institutions. So I would say if I was being threatened with tariffs, I would probably say, well, I can't then go back to my constituents and keep my sovereign wealth fund invested in US stocks. I'm going to bring them back home. It's a good time to sell. U.S. stocks are at all-time high. Our stocks are at not an all-time high. So there's a really good trade to be made there. And on the next slide, you can see what that means. The head of Norway's sovereign wealth fund was at Davos in mid-January, and he basically alluded to this, saying, "I'm not saying that we are doing it, but this would be a good thing to do." I'm very confident that Norway, at the very least, sold some U.S. stocks and bought some European stocks. The Swiss national government has a pension fund. State Street, the U.S. asset manager, is its money manager. And they actually held a vote to remove State Street as the manager in Parliament. This was an official vote, and it almost passed, 98 to 89. I do not think that this was an indictment on State Street's skill at managing assets. I think it was a play to get money out of, giving it to a U.S. institution. And so these are things that are happening, and it make a lot of logical sense, but it means there are significant outflows from U.S. markets. And you can see this on the next slide. The gray bar are asset flows into Germany. The yellow is into Poland, of all places. And the orange is the United States. And what you've seen is this is a percent of the market capitalization of those areas. And the fund flows into Germany and Poland have been multiple standard deviations of what is normal records. And the US is significantly below kind of its average. You can see where it was in November, December, and where it is today. It was about a quarter of where it was in November. And so this has had significant impacts on the divergence in terms of the US stock market and European stocks. On the next slide, you can see what's happened to Poland. Poland is up about 35% year to date. This was at the end of the quarter. And at the time, the US stock market was down, low to mid single digits. These fund flows certainly contribute to the outperformance of European stocks over US stocks. The fundamentals have not really diverged. If anything, they're diverging the other way. And so I think this is something to note. It's not just that, Poland, the Polish economy is on a tear and the U.S. economy is going down the tubes. This is very much a market mechanism of what happens when a bunch of foreign investors pull their money out of the United States.
Yeah, I think it's important to note too that if you take the three largest economies, you take France, Germany, and the UK, all three of these countries aren't exactly looking at massive GDP growth. Germany, the expectation for 2025 is a whopping 0.3% growth in GDP. France is sitting at just a mind-blowing 0.7%. And the UK was just recently downgraded from 2% to 1% for the full year. And each one of those economies is not diversified. It's not covering all the bases like the U.S. economy is. I mean, UK is essentially a banking institution. You have France, which essentially makes only the things that you would want in a medieval castle, like fine wines, cheeses, and handbags. And Germany makes cars. I mean, they're an industrialized manufacturing. So you combine those three together, and you still don't have half of a diversified economy, all of which are growing at just absolutely comically low levels, and are looking to take on more debt. I mean, that's the big thing with Germany is they're suddenly going to spend $500 billion in excess of their deficit or in excess of their budget for defense. And of that defense, $100 billion is for defense against the sun. It's climate change defense. And so you got to figure, like, is this the type of economy you want to
So
be
much
investing
sunscreen.
into? Yeah. I mean, yeah, it's $100 billion. They're just going to start firing rockets to the sun. Maybe they will. I don't know. But, I think that from a fiduciary standpoint, would you take the U.S. that's suddenly 10% on sale after the last couple of weeks, and then turn around and, I mean, you're going to want to put money into those three economies? I would not.
Yeah, I mean, you can see it on this chart too. We've had record outflows of the United States and record outflows of equities into the Eurozone, into the United Kingdom, into emerging markets. And this was in March. Now, I think that we've had outflows of everything here in April as a result of the tariffs. But 40 percentage point decline in allocation. These are fund managers, 260 of the biggest fund managers that are surveyed by Bank of America every month. And you're seeing them pull out of the United States and allocate to the Eurozone at record pace. In our experience, fund flows can really dictate short-term market trends, but have no bearing on underlying fundamentals. And so for that reason, we would, and, kind of have faded a lot of these flows in March, and I basically use that as an opportunity. If the rest of the world is indiscriminately selling U.S. stocks, then we can be judicious, put put on our Warren Buffett caps and actually parse through that indiscriminate selling to understand where the values are. And that's what we continue to do today. Now we have the added complication of tariffs, the reciprocal tariffs that have been implemented. But this was really the driving piece of the market declines, especially in February and to a lesser extent March. Moving on to inflation, because we wanted to address that, and I think this changes by the hour, the inflation forecast. Here I want to make the distinction that Goldman Sachs has been exactly right on the path of inflation year to date. We have that one little dotted line. Where they've changed their model is taking it from the no tariff baseline to the previous baseline and now to the 3.5%. And this came out prior to the reciprocal tariffs coming in higher than expected. So when you look at this, I just want to emphasize that these are all forecasts. These are forecasts that are based on narrative, not the data that's come in. This is based on what economists model. And if you think back to COVID, economist models got it phenomenally wrong. I was in a MBA class at the time, and I distinctly remember the professor saying this could be 25, 30, 35% unemployment for years. This was in June of 2020, after the market had bottomed. And that isn't to say that classical economics is wrong, but I am saying, and I think all economists would allow, that there are many varying countervailing factors. And if you're saying we're going to get to 3.5% core PCE inflation, well, if we're saying 60 to 70% of that is services, that means your 30% on goods are going up 25% to accommodate for that. So I think that's important to note. On the next slide, you can see where the trends actually are. And this is, the trends basically where they have been. Inflation, depending on which measure you look at, has kind of settled in this 2 to 3% range. I think probably a little bit more biased to the 2.5 to 3% range. On the next slide, you can see goods inflation. Goods inflation has picked up because we've been in a goods recession ever since COVID. But you can see again, we had 12% inflation in goods outside of food and energy. Again, this does not include your eggs prices. This does not include your oil prices in 2021 and 2022, your gasoline prices. So we had substantial inflation in goods prices that has now ticked up to a grand total of 0%. So will the tariffs probably add to this? I think so. Will it go up to 10% again? I do not think that. I think maybe we go to 1, maybe 2% in aggregate.
Yeah, I think there's we're stuck in this range, and I think we talked about this at our economic symposium that the 10-year is going to be the driver of inflation. We started this year with the 10-year at 4.85, which is extremely restrictive to the economy. And surprise, surprise, we saw inflation really fall all the way to this point. One thing that's sort of underrated in the last couple of days is that interest rates have fallen significantly. I mean, we got down today to about a 3.80 on the 10-year, which should dictate that mortgage rates should be somewhere in the 5.5% range today, which is extremely low for the last 4 or 5 years. Suddenly, we're seeing an opportunity to refinance these very high mortgages. We're seeing an opportunity. I mean, the 2 years fallen to 3.50. It's up a little bit from there, but I mean that's auto loans. That's short-term borrowing. If you think of the 10-year as the rich man's interest rate and the 2-year as the poor man's interest rate, we've seen both of those fall dramatically in the last few weeks. You combine that with the fact that food prices are falling. Eggs obviously down more than 50% since Trump took office. Gas prices are coming down at about as fast as they ever have, and interest rates are all falling simultaneously. What that means is your walking around money is increasing as we speak. The cost of walking around and being a person in this economy is getting better every day. When the Fed, they like to look at core PCE, but that eliminates food and that eliminates energy, both of which the common person are using all the time. And,
That's pretty core.
Yeah, we saw the split between the headline inflation was 2.5 and core inflation was higher than that. But core is not really what people feel in the streets every day. And I think that's important. And
Jay Powell said that. before.
Yeah, yeah.
And
So
he,
it's
to his credit, he acknowledges that.
and so it's we're coming out for the average person in a place where you're going to feel it more in the next few weeks, I think, feeling better about prices. But I think that the 10-year coming down is going to drive inflation upward again because people are suddenly going to buy houses. I mean, the cost of housing is coming down. I mean, one, the government was printing money and spending it to put people in housing units all over this country when that has come to an end. But the thing is, there's only so much housing, and suddenly that's becoming more available. Interest rates are coming down. That brings housing prices down. I mean, the prices of the houses will probably remain about the same, but the number of existing homes that are now going to change hands is going to increase a lot. That's going to unlock a lot of cash for people who've been sitting on these 2% mortgages for 5 years who want to get into a bigger house. They can take all that equity and they can move that, put it in motion. They can then take the excess, they can buy things at Home Depot to put in their houses or Restoration Hardware or any of these publicly traded companies that are going to do well if the housing market comes alive again. And it's going to. And even if it's just refinancing, you go from a 7.5% mortgage to a 5.5% mortgage, you're probably picking up $500-600 a month in walking around money, and that's a major impact
And that's
to this economy.
opponents of Trump, especially on the tariff issue, love to point to the Trump consumption tax, which is kind of this mythical figure that they've been citing really since the campaign trail going back to September, October. That is the Trump tariffs, although they had no idea how they would be structured, who they would be against, what the dynamics would be. They determined in some way, shape, or form back in September that that was going to cost the average American family $6,000 a year in additional costs on things that they consume. Obviously, that number's not going to be correct. If it were, I don't think we would have any market reaction to what was announced earlier this week because we would be saying, oh, well, we already knew what it was. We knew how it was going to go. But let's say that that $6,000 is correct. If you refinance your mortgage at a lower rate and you save $500 a month, you're break even. And at the same time, the United States is getting some new revenue, probably reindustrializing a bit. There are a lot of, I think people are looking for an off ramp specifically on the tariff or specifically on different inflation components. And the reality is it's much more of a mosaic in which we are not going to have direct offsets necessarily. But if there's any credence given to any of these policies, there is a path to which things start to balance out a little bit quicker than I think anyone expects.
Yeah, and let me just illustrate what Tom and Andrew have rightly said. Core service inflation has been the key sticky area when we're talking about inflation coming back down. A lot of this is due to auto insurance. Auto insurance is still up 11%. To Tom's point, we've had an historically long market, a long, very firm market in auto insurance, and that is just taken a while to come down. A lot of that's due to regulation. A lot of that's due to these nuclear verdicts, but a lot of that's trying to get worked out right now. So auto insurance potentially coming down. Travel, we talked a little bit about this. Travel inflation still, 10, 12, 14, 15% up year over year. I was looking at airfares earlier today, just kind of prepping for this presentation, and those airfares are cheap for the first time in a while. We have over transatlantic bookings that are down 25%, not fares, but the demand is down 25%. What's an airline going to do? Well, they got to stay in business over the summer travel season. So they're going to cut prices. Just go on Google Flights and see how much these flights cost. And for the first time in a while, you'll be surprised that the flights actually seem somewhat reasonable, especially on competitive routes. You can fly round trip to New York for 19,000 miles on Delta. I was getting hit with ads on that this morning. So I do think that you have some tailwinds at your back. If we're looking for offsets to this potential tariff inflation on goods, services is one way to get it. Home prices on the next slide. As Tom mentioned, those are kind of coming down. The orange line is the one that's used in the CPI calculation. The green line is what we're seeing on Zillow. And I was looking at a Redfin report earlier today, and we're seeing the majority of homes in America are transacting below selling price. This is kind of a little bit more of a normal market. 68% of condos are below selling price, are actually translating below excuse me, transacting below the asking price. So these things are all good. And then energy prices, of course, they have a correlation. This is the highest single correlation with the consumer price inflation index, zero point 0.6 correlation. 50% of the observed variation in the CPI is due to observed variation in the oil prices and gas prices. Well, oil prices and gas prices have been down about 15% over the last 2 days. This is going to be a huge tailwind as we look for inflation going on.
And that's not
Big,
even on this chart. You can draw a nice straight line
exactly.
down to the right on the end of this chart, and that's where oil prices are.
Consider paying a 32% tariff on Nike shoes, for instance. That $25 shoe that you're purchasing for, and you're going to buy at a retailer for $150, that $25 shoe might now cost $35. But your freight cost to transport that across the entire Pacific Ocean is going to go down markedly. Think if your restoration hardware, you're importing teak from Indonesia. How much does that cost to transport? It costs per kilogram. So there are a lot of offsets here, and energy prices certainly would be one of them. And then Tom mentioned interest rates. Again, these have fallen, so it's really not even worth mentioning right now. But our big bogey is 5.99 on the mortgage rate. We're not there yet, but if we just hold around 4%, as the volatility comes down, I would expect that the mortgage rates come down below 6.
We could very well be there tomorrow at the rate that rates have fallen again today.
Indeed. Economic activity did slow in Q1. We had some really bad weather in January, and then the consumer was weak as soon as Valentine's Day hit. Everyone spent all their money, and then after Valentine's Day, things slowed down. People got a little bit concerned more about tariffs. March was better. Question was, why was March better? Was March better because people were doing pretty well, or was March better because people were trying to front run these tariffs and buy as much as they could before the tariffs? And I think it is probably a combination of the two. Auto sales were extremely strong. But what's very interesting as we look through a lot of these company comments is that they reported earnings, and the earnings were extremely, they were better than expected. But they gave guidance for the current year that was significantly below expectations. And the reason they did that was because they were concerned about tariffs. They're seeing the articles the same as you and I, and they don't want to miss their numbers for the year. They just had a great quarter. They're not going to set the bar too high and then have to underperform and be in this pattern of lowering guidance over the balance of the year. So they're going to set the bar low. And I think that as we get into Q1 earnings season, the mainstream Q1 earnings season that'll happen in the last 2 weeks of April, you're going to see a lot of companies do that as well. So as I look at the economy, I think that we're probably going to see relatively robust numbers from a lot of these companies, but they're going to reset the bar lower for the balance of the year. And then the smart ones are going to buy back a ton of stock because they know they can beat those estimates.
And we're in a blackout period now in a big way, which makes me think that, we may not have necessarily reached the bottom, because a lot of times when you see market moves like this, you see the companies jump in and buy back a ton of stock, but, they are legally obligated not to at this point in time. And so I think that there's, mostly retail money coming here. There's a lot of rebalancing going on. I think people are scared and just getting out. And so I think that, we talked about this yesterday. Ben and I did. If you buy stocks today and grit your teeth and do it, you're going to be very happy in 6 months to a year. You may not be happy in 4 weeks or 6 weeks, but there's still opportunity there. But I think that to your point, when buybacks start to kick in, it's going to be insane. And I mean, Apple is a great example. Most of Apple's upside is a function of financial engineering. Yes, they make a ton of money. But what they've done over the last, 25 years is just hyper engineer their stock. They've done massive buybacks. And I would not, say that they aren't going to do that again, given the opportunity. I mean, Nvidia's at $94 or something. I mean, it's sub 100 now. That's a stock that was cruising towards 200 just weeks ago.
Yeah, and I think this is exactly the point, Tom. We got to separate the data from the narrative. And the data is saying, especially in U.S. cyclical industries like LTL freight, less than truckload freight, which is kind of close to demand, and at Fastenal, which is a huge industrial supplier, We've actually seen a couple of years of significant recession in both these sectors in the manufacturing sector, and both have reported very consistent positive trends, really beginning from the end of last summer. And I think that is the data that we're getting right now. The narrative is things are about to get really bad. Um, but the data so far is quite good.
I mean, even Jay Powell, an hour and a half ago when he came on, said the data that we're seeing is showing strength. And I think that I would agree with that. And, there's, you look at projections on rate cuts this year from the Fed, it's, roughly 3.5. Why would they cut rates? The 10 years dropped 130 basis points in 40 days. That's the equivalent of a full point rate cut.
While we are seeing an acceleration in employment.
Yeah.
Yep.
It doesn't make any sense. That like people are talking it up like we got to get the Fed to cut rates. We got to get the Fed to cut rates. They don't have to. It's
Yep.
done. It's been done. The market took care of it for them. And as a result, the economy will be stimulated by the housing market.
Indeed. This is, again, expectations versus reality. You have the expectations. This is from a Dallas Federal Reserve survey that comes out monthly. The expectations were far too high in November, December. And then they've absolutely cratered in the last month and a half. But if you look at new orders, the trend is much clearer. And that is we're seeing a gradual recovery in manufacturing in the United States. And this has been on the docket for quite some time. Expectations can go highly up and down, but the reality is things are slowly improving. At least they have been through the end of March. The comments in this survey were remarkable.
There's such a good read through on why the expectation data is not only, in some cases, pretty useless, but also driven so much by political polarization. These two from the same survey, but from different respondents, one saying, I'm thinking of closing the company. The other saying, finally, we can get back to work steady and higher level than 2024. Same time period, same survey group. Clearly a differing opinion. When you have a lot of people answering questions in both of those ways and you put them together, you're going to get predictive data that is not predictive, and it's not data.
I mean, the University of Michigan inflation sentiment from 2 weeks ago came out at 4.8%. And when they broke down the respondents, left-leaning respondents said that inflation was going to be 6.5%, and right-leaning respondents said that it was going to be roughly flat. And CPI had come out the day before, and it was roughly flat. So there was data, but there's a perception problem where people perceive the world to be crashing around them, but the reality is that things are actually getting slightly better. And it's just that's what's causing the most anxiety around here is that people are following the narrative, they're not following the data, but that is creating opportunity.
Yeah, so let's look at the data. Some people are exciting this data. It's the Atlanta Fed GDP Now estimate. This changes daily. Negative 3 points. I think maybe now it's negative 2.8, but almost 5% of that bottom right. If you follow net exports on the top, the second column from the right, and go all the way to the bottom, net exports is a drag of almost 5% on GDP. So you got to understand the GDP formula. Basically, you add in exports and you subtract out imports. So if you're in March of 2025 and you know tariffs are coming and you're a big retailer, what are you going to do? You're going to surge imports. That's a drag on GDP, as you can see for the formula. That's the M in the formula there. So this is why GDP is negative. And so a lot of people citing this saying how the economy is crashing and GDP is big time negative. Yes, that is factually true. The second piece, no, the first piece is wrong. It's because people are surging imports. So I think that's important to note.
And the G as well, government spending. I mean, there's an active war on government spending. If you look back at GDP over the last couple of years, somewhere between 40 to 60% of it has been government spending. And what did we get as an economic return from that? Inflation and higher interest rates and a goods recession and a manufacturing recession. So if we can increase C and I, and then reduce G and then get X, what we're on pace for a growing economy. that's real growth, because everyone knows a dollar spent by the government does not yield the same economic effect as a dollar spent by you and me, because the government is not good at spending money, and they've been spending more
Well, they're
money
great
than
at
anyone.
spending money, but
Yeah,
they're not efficient at
yeah,
it.
yeah. They are. Yeah, they don't have a concern for return on invested capital, whereas you do, I do, and anyone who runs a business certainly does. But the government is not a business. Uh, you could argue that it's sort of a parasitic vampire slug, if I had to describe it. And it's gotten bigger and fatter and more full of all of our blood in the last 5 years.
And that when we've been trying to extract some of that those parasites, Andrew, we have multiple articles in the Wall Street Journal going after healthcare industry. Again, a big reason for the decline in air travel inflation was because government employees are flying less. Um, what are your thoughts on where we go from here in terms of government efficiency?
Yeah, I think it's certainly been interesting to see, at least for this week, midweek, some of the attention come off of Elon Musk and what he's doing with Doge and come back onto Trump and what he's doing with tariffs. I think that it's a slow process. I think people are experiencing, just as we explained with tariffs, they're going to experience some pain points. There's going to be some friction. There are going to be some people laid off that probably shouldn't be laid off. There's going to be some programs that are cut that probably shouldn't be cut. But I continue to have some optimism. I think it's actually quite politically popular from both sides of the aisle to suggest that there is a decent amount. What that amount is, who knows? But there is a decent amount of inefficient spending by the government. That's not an unpopular take. That's not a take that really anybody would disagree with. Finding that in a expedient way is the challenge before Elon Musk at this time and his team. They're certainly identifying things, but it kind of goes into the bigger mosaic. I think anything that we can do to be more responsible on the spending, I would argue that that may be more impactful long term than anything we do on the tariff or trade policy side. I think if we can reframe our elected officials' thinking on how they spend tax receipts, that could be quite lasting, as we've already seen, even under this one president for 2 months. Trade policy can change, and it can change quick. But can we change some habits on the spending side? That's what would, I think, really instill some confidence in middle America.
So our view, kind of going forward, is that this chop is going to continue. It's going to continue to be rocky. I mean, Tom brought up, we're in a blackout period right now. Foreign investors and foreign institutions aren't going to join in and buy a lot of stocks. Federal Reserve is hawkish. They're not dovish right now. So there is some negatives here in terms of in terms of the short term, but the second half should be better. And reasons why the second half should be better, we've discussed. You've got this baton handoff between the public sector and the private sector. That'll continue. You have the Doge impact. Elon Musk is going to probably likely be done. A lot of the big heavy stuff is kind of out of the way, big headlines. I think there's still some unresolved questions in healthcare that we'll talk about, and that's one thing that we are taking note of as we look at portfolios. Interest rates, as Tom mentioned, are down about 100 basis points from where they were previously, and the tariffs. I think at this point they're probably more likely to go down than up. There is the threat of reciprocals, like we saw with China, but I think on the whole, if I'm another country and I'm looking at what China doing, I'm going to take Mexico's route, which is Mexico's playing nice, and all of a sudden they're getting reprieves from tariffs like this.
And we saw a statement, frankly, of relief from Scheinbaum.
From Scheinbaum, the UK is doing the same thing. And so we're definitely seeing people who are willing to make friends and make friends early are getting benefits. And I think if the administration's able to do that, I think that the tariffs are more likely to go down than up, not to zero, but where we are today, I think we might get a little bit easier.
And Argentina dropped all tariffs. Is that correct?
They're in talks to
be
the first. Yeah.
And I mean, notably, that's one of the largest places that we import beef from.
Yep. So as we think about it, if the second half is going to be better, the next question is, okay, well, what's the timing and what's the starting point? And I don't have great answers on that. But I would say, if I look at the balance of risks, things are likely to get better than worse. Um, Coming into the year, we noted the market was needed to broaden out. We'd had remarkable concentration last year. The overall market was up 25%, but the equal weighted S&P 500 was only up 13%. And so, what we want to see is the market broaden out further, and especially if it rallies, we want to see more companies benefit. And so, as we're looking at positioning portfolios, that's exactly what we're going to do on the next slide. The big theme for us is that investing is back. For a while, it was, trying to allocate to increasingly aggressive AI expectations, and trying to manage risks around that. And now, as the market pulls back, like I said earlier, we can put on our Warren Buffett hats. Look what has cash flow. Look what has cash. Look who's deploying capital effectively. Look who's generating good returns on invested capital and investing in companies like that. We were looking at a company in the UK called Relics earlier this week, and this company is they run LexisNexis. They have a bunch of fraud solutions, risk. They're $100 billion company no one talks about because they're based in the UK. They traded at a 30 times price to earnings multiple, which might seem a little bit high, but their cash flow is phenomenal. And Thomson Reuters, which is one of their competitors, trades at 45 times because it's US listed. And so these are the types of companies that, pique our interest. It pays a 2.5% dividend yield. So, we're looking at companies like that. We're looking at companies like Universal Forest Products, which is based here in Atlanta, that is going to be insulated and actually positively levered to a potential rebound in housing or home renovation. And I would say that some parts of the Magnificent Seven, those biggest companies, are becoming a little bit more interesting. If I look at Microsoft, it's trading at $380 a share. It was at $460. Amazon, trading at $175 a share, and in tremendous franchises. So as we look at the equity landscape, there's a lot of opportunity. Again, the two biggest question is what is the starting point for the rally and what is the timing? And so what we're inviting a lot of clients to do is basically taking the approach of let's not pour all the money in right now. Let's not shoot all your bullets just now. But as bonds go up and as equities drop, we sell some bonds and buy some stocks. Not only that, but bonds are going to continue to generate income. They're going to continue to mature and create cash in accounts, which then we can then deploy into stocks. And this is a beautiful thing that we haven't had
in a while.
In a while. We certainly didn't have it in 2022.
Everything was moving the same direction.
And even within bonds, we now have great opportunities in municipal bonds that we didn't have.
Yeah, so it's been an interesting last few days. So when we put this together, there was a lot more opportunity than there is now. But I think our opportunity really relies on, to Ben's point, we were very active in setting up, what I thought at the time might be permanent short-term treasury ladders to make sure that we had cash coming due constantly. And we were doing that up until the last couple of days. Now, even outside of 6 months, buying treasuries is not really a great value proposition now, but we're still doing that in order to make sure that, 2 months, if you're a brand new client, we bought treasuries that are going to mature very shortly. And when they do, we can use that money to flow back into equities. But long-term munis are definitely still the shining star of value right now in the bond market. The reason being is that issuance has increased quite a bit. There's a lot of chatter about losing the tax-free status of municipal bonds, which has been talked about. I mean, as long as I've been in the bond trading business, going all the way back to the Obama administration, there was talks of doing that. I think they'd be very hard pressed to do that. I mean, ironically, in 2018, when Trump put in his tax changes, it made it very difficult to issue new municipal bonds, especially as it relates to refinancing those bonds. And so there may be a piece that comes in that's going to hamper the availability of them, which I think is probably more likely than not, but that doesn't affect their tax-free status. And that's the reason why they're selling off so much. I mean, the muni bond market is up like 65 basis points roughly year to date before today. The bond market itself is up closer to, call it 3 on the ag, because that's primarily driven by treasuries and corporates. And so there's a big disconnect there. Plus, you're getting a tax-free status. Plus, they're typically much longer than corporates. So we can start to feed those in and say, hey, somewhere in the 375 to 4% range is kind of where we're seeing paper tax-free for, till 2035. That's a great way to add duration where the rest of the curve is cratering and also add that tax-free status. And so I don't think that taxes necessarily are going to go down anywhere from here. I don't know that the Trump administration is going to be able to get through all of the, make the permanent changes to the 2018, slew of tax cuts that we got necessarily. And so having that status is very opportunistic right now, especially for some of our higher earning, higher net worth clients that have a high tax rate. But in the meantime, I mean, you'll probably see us selling some bonds, probably some of the short-term treasuries ahead of their maturities. I mean, I sold some bonds. It's like they mature on the 15th. Between now and then, we'll make $8 in interest. We might as well sell that and turn around and buy some of these stocks down 10% in the last 2 days and start to take advantage of the pullback. And so, it's not what it was. I think I'm going to have a real sad time going and buying bonds at these levels after having, call it 3 full years of buying stuff at prices we'd never seen before, not since 2006 or so. But that's why we structure the portfolios this way. And, depending on how many bonds you have in your account, your total portfolio is doing a lot better than the market because we're seeing a step up and upside every single day in bond prices. And so that's very helpful for the portfolios.
At this point, we'll take some questions. I know Andrew's on that, but
yeah, I think we got to everybody that sent one in.
I do know there was I had one question coming into this that kind of to that point, Tom, in terms of how do we reallocate given the market volatility, and I think the primary reallocation that we want to do is on the fixed income side. Can we sell some treasuries and buy equities? Can we allow treasuries to mature and buy equities, or even some fixed income ETFs that we added earlier this year, so that we had the agility there? And so we're doing all of that. That's the primary reason, primary method. But the secondary method is on rallies, we will look for potential losses to sell, and then reallocate into things that we think have a more favorable risk and reward profile. So companies like that could include, I mentioned some of the healthcare names earlier, but things like potentially HCA, the hospital system that may be at risk if Medicaid spending gets pulled back a little bit. I don't think it's going to get cut, but just gets pulled back. People don't double pay insurers. And then the insurance companies as well. So these are all areas where we're looking to potentially reallocate to things of more favorable risk reward profile.
Awesome. Thanks, Ben. Thank you, Tom. Thank you to super producer and chief compliance officer, Jonathan Hicks. He's the man. Appreciate you all for being here. If you have questions that you'd like to discuss off air, don't hesitate to reach out to us. Again, we'll try to get this posted up on the blog, all that good stuff. But hang in there, hang tight. We're going to stay active and disciplined, and we will talk to you all soon.